Hello everyone, this is Dave and DJ Boyke from Retirement Resources. I just wanted to share a video with you today, talk a little bit about what we're seeing with the market and the concerns that people are having based on what's happening with the market right now. I know a lot of our folks are concerned about the decline of the market, maybe some concern about inflation and rising interest rates, as Dad and I have both talked about for a few years. So we want to share a few things about that and just kind of share how we're feeling about it and what we're doing about it and what our managers are doing about it. But before we do that, I would like to share a slide with you that should be coming up at this point, talking about why investing with our emotions can be very costly. A lot of the concerns that we're getting right now have been about should we be going to cash, should we be taking our money out of the market and moving into a cash position to preserve it. Dad's got a couple slides he's going to share with you. I have one I want to share with you as well, talking about the emotions of investing. The first part of it really talks about, what we've said for many years that, and most of you know that you're supposed to buy low in the stock market and sell high. What happens a lot of times is we end up doing the exact opposite. We end up buying high and selling low because our emotions are getting involved in it. Generally, as the market's going up, you can see on the graph here that people are getting encouraged. They're confident. The market's doing really well. We start to get thrilled. And at the very last, as everybody else is telling you about how much money they're making in the market, we become euphoric with the market. We're very excited about it. It's at that point in time where the majority of individual investors, not the big corporate type institutional money managers get involved, but the individuals get involved at this point during the euphoric phase, and they start investing money. They're buying high. And then unfortunately, as time goes on, and as cyclical as the market is, the market starts to drop. And at the very beginning, of course, you see on the chart, people get surprised. Whoa, what happened? The market's down 1,000 points. They become nervous. It's 2 or 3 days in a row that the market was down. At some point, they become worried about their own retirement, worried about their own investments. And at the very end of it, when the market seems to be at its absolute worst, they become panic stricken. And it's at that point in time that people decide that they need to sell. They need to protect whatever it is that they have left. We've seen this many times, most notably as the latest one was in 2008. By June of 2008, people were all panicking and wanted to move to cash. And unfortunately, that was the worst time to move to cash, because following 2008, and that summer of 2008, we basically went on a 13-year run of what was at that point one of the greatest market runs in our country's history.
And DJ, is some of those people that either with us or maybe they were working with another advisor and they sold out and they went to cash, they locked in those losses. In other words, they sold for less than what those stocks were worth. And a lot of those clients or those people, they had a hard time getting back in. I mean, how many of those people we talked to during that time came to us with 2, 3, 4, 500, maybe even $1 million in cash? And today, that's going to get you what, 0.1%? But then they had such a hard time getting back in. And they missed out on one of the greatest bull runs in the history of the market.
Yeah, so for us, I guess what we're sharing with you is we are not for moving money into a cash position as during this downturn. We're locking in, we're realizing those losses, and that's not something that we're recommending at this time. Again, we know the market is cyclical. It will move up, it will move down over time. And just as it's moving down right now, at some point in the future, for those that stay the course, that have the proper planning done, which we've done with our clients, the market will move back up again going forward. So Dad, why don't we go ahead and move forward now, and why don't you share that slide that you have, talking about how we're going to use our different strategies during this volatile market period.
Yeah, I'd be happy to do that. And if you take a peek at the slide that up on your screen right now, basically this is a chart over the past 20 years. If an individual investor had $100,000 and invested it in the S&P 500 index fund, $100,000 over the last 20 years, if they just put it in and they left it alone, believe it or not, through this incredible bull market run, over the last 20 years, on December 31st, 2021, that $100,000 account would be worth $616,000 plus. So an incredible rate of return simply by putting the money in and leaving it alone. Now, what happens if that same individual got spooked at some point and just took the money out for a short period of time, went to cash? What would have happened? If he missed just the 5 best days in the market, believe it or not, that return would have been cut in half. Instead of sitting there at the end of 2021 with $616,000, he's got $389,000. A significant difference from just missing 5 of the best days in the last 20 years. And as you look down the chart, you can see the more days that a person missed, the worse it got. Missed 10 of the best days, you're down to $282,000. Miss at the end 25 of the best days, less than a month. Miss 25 of the best days, instead of having $616,000, you've got $134,000. So what is this chart teaching us? It's teaching us historically that over the course of time, it's better to decide who you are as an investor. Are you conservative, moderate, aggressive? Build a portfolio around that. Have some money in cash for the short-term emergencies to get through times like this, but leave your money invested with professional money managers. Let them do the tweaking. Let them make the modifications to that portfolio. But the idea of jumping in and jumping out, trying to time the market, there is no empirical proof for that. It's never worked. We've had dozens and dozens of people come to us and try to show us what they did, and most times they failed miserably.
You know, one of the ways that I'd like to illustrate this a lot of times is when people look at the market, when the market's going down, very rarely do we ever see the market go down, flat line for a year or a month or even a couple of months. Generally when the market goes down, it looks more like an EKG where it's bouncing up and down in a very sharp pattern, sharp angle. So again, that's just basically showing us how short sometimes these downturns can be. And so if we take the money out of the market, generally when the biggest market losses happen, shortly thereafter are some of our biggest gains.
Right.
So if we take the money out just when we're panic stricken, we may not be able to get the money back in time, or we may not be able to guess, more than likely not be able to guess when the market's going to be going back up.
Well, you got to get lucky and guess right twice, DJ.
Yes.
You got to guess, well, when's the best time to get out? When's the best time to get in? And there's just no crystal ball, folks. It's more about planning. So those of you that are our clients, we've kind of walked you through this. We've talked about those having money in short, mid, and long-term buckets, and we've prepared for this. So if you have any questions or concerns, just pick up the phone, give us a call, shoot us an email, we'll get back to you. And any of those folks that are not our clients, that they'd like to have a free, no obligation consultation with us, man, just give us a call. Go to our website at www.theretirementresource.org or shoot us an email, give us a call. We'd be happy to get on the phone and give you a free half hour of our time, see if we can't help you be a little bit more confident during these days and weeks ahead.